You probably checked your bank balance this week without thinking twice about it. Maybe on your phone, standing in line for coffee, half paying attention. You saw a number, and some part of your brain just trusted it. Trusted that the number was real.
I'd
Trusted
like
that if
to
you
make a
walked into a
deposit.
branch
Certainly.
tomorrow
May I
and
see the
asked
slip?
for your money,
Here you are. Thank
someone
you.
would
I'll
actually
process
hand
this.
it to you. That trust is so basic to modern life, it barely registers as a belief at all. It just feels like a fact of the world. Like gravity. Your money is safe in the bank. End of discussion. Here's the thing, though. That fact is younger than your grandmother. For more than a century and a half of American history, there was no such guarantee. None. Not one. If your bank failed, and banks failed constantly, your money didn't get frozen, or delayed, or quietly refunded through some government process. It was often just gone. Whatever you'd worked for, saved, inherited, decided to trust to a vault instead of a mattress, could disappear in a single afternoon, and nobody was under any legal obligation to give you back a dime of it. So what actually happened when a bank collapsed before 1934? Did people just accept it? Did anyone riot? Did anyone go to jail? Did the government step in at all? Or did everyone just quietly absorb the loss and move on with their lives? And why did it take the single worst economic catastrophe in American history to fix something this basic? The idea that money you deposit today should still exist tomorrow? Here's what's coming. A crowd of thousands freezing outside a locked bank door in the Bronx, with no idea if they'll ever see their savings again. One of the most respected bankers in New York, staring down a run he can't stop, and a decision by the most powerful financier in the country to simply let him fail. A state government that tries to solve this problem on its own and goes bankrupt trying. A newly inaugurated president who responds to a national panic by shutting down every single bank in the country, all at once, by decree. A fight in Congress between two men who agreed on almost nothing, except that this had to end, and a policy so effective it turned 9,000 bank failures into 9 in a single year. This is the story of how "your money is safe" stopped being a hope and became a fact, and how long America let people gamble everything they had before it finally decided that price was too high to keep paying. Picture a small-town bank in the early 1900s. Brick building, maybe a marble counter, a vault door that looks impressively heavy because it's supposed to. That's the whole point. The building itself is a kind of performance, designed to make you believe your money is safe just by looking at it. For most of American history, that performance was the only thing standing between you and losing everything. There was no FDIC, no federal insurance, no promise of any kind from the United States government that a dollar deposited today would still be a dollar tomorrow. Banks were private businesses, and like any private business, they could fail. Here's the difference, though. When a shoe store fails, you don't lose your shoes. When a bank failed, you lost your money. Not metaphorically, literally. The bank had usually already lent most of it out, tied up in mortgages and loans that couldn't be called back overnight. So, if depositors panicked and everyone tried to withdraw at once, there was often nowhere near enough cash sitting in that vault to cover it. That impressive door didn't matter one bit. It could be full of promises instead of money. And nowhere did that play out more dramatically than in New York City, in October of 1907, at a bank that was supposed to be one of the safest in the country. The Knickerbocker Trust Company occupied a building designed to look like a Roman temple. White marble, towering columns, the whole point being to radiate permanence. By 1907, it was the third largest trust company in New York, holding something like $62 million in deposits. Its president, Charles T. Barney, was about as socially connected as a banker could get. This was not some fly-by-night operation. This was the establishment. Then a completely unrelated scheme collapsed. A financier named Otto Heinze tried to corner the market on a mining company's stock. The plan fell apart within days, and the stock crashed. Barney had loose financial ties to the men behind that failed scheme. That was, weirdly, enough. On October 21st, Knickerbocker's own board forced Barney to resign over the association, and that same afternoon, a major New York bank announced it would stop clearing checks for Knickerbocker entirely, which, in the language Wall Street understood, was a public vote of no confidence. The next morning, the run began. Depositors poured in, and as fast as one person left, 10 more arrived to take their place. The bank sent for police to manage the crowd. Trust company officials physically pushed through the mob, trying to reassure people they'd be paid in full. It didn't matter. In under 3 hours, depositors pulled $8 million out of Knickerbocker, worth well over $250 million in today's money. By early afternoon, the vault was empty enough that Knickerbocker simply had to shut its doors. Here's the detail that should chill you a little. J.P. Morgan, the most powerful private banker in America, sent one of his people to examine Knickerbocker's books that same week to decide whether to bail it out. His man couldn't determine in time whether the trust was actually solvent or not. So Morgan made a call and refused to help. He let Knickerbocker fail. Barney was dead by his own hand within a month. That one failure at one prestigious bank in one city was enough to spark a full-blown national panic. Runs spread to other trust companies within days. Interest rates for emergency loans spiked past 70%. The stock market cratered to lows not seen in years. All of it traced back to a single bank that looked, right up until the moment it didn't, exactly as safe as any bank in the country. Here's the strange coda to that story, though. Knickerbocker itself actually reopened a few weeks later under new leadership and eventually paid back every depositor in full, with interest. Which tells you something important. The bank hadn't necessarily been doomed. The panic itself, the sheer speed of the run, was what nearly destroyed it. Not some unrecoverable hole in its finances. That's a distinction that would matter enormously, decades later, when people finally sat down to design a system meant to stop panics specifically, rather than just cleaning up after them. The lesson people took from 1907 should have been obvious. This can happen to anyone, at any size, with no warning at all. And yet, in the years that followed, nothing structural changed at the federal level to stop it from happening again. So if the federal government wasn't going to protect depositors, somebody had to at least try. And in the early 1900s, a handful of states did. Oklahoma is the clearest example. In 1908, the state set up its own deposit guarantee fund. Banks would pool money together, and if one of them failed, the fund would step in and make depositors whole. Sound familiar? It's almost exactly what the FDIC would eventually become decades later. By the time all of these state experiments had run their course, only about 8 states in the entire country had ever set up anything like it. The rest of the country had absolutely nothing. That's worth pausing on. Out of 48 states, only a small handful even attempted a safety net for depositors, and the rest simply left people exposed indefinitely with no plan at all beyond hoping their particular bank happened to be a well-run one. For a while, it actually worked well enough to convince people it was a real solution. Depositors in Oklahoma had recourse. Depositors in a few other states had something resembling the safety net people take for granted now. But there was a fatal flaw built into every one of these funds. They were only ever as strong as the banks paying into them. One bank failing here or there? Fine. The fund could absorb that. A genuine crisis, a wave of failures hitting all at once. That was never something these funds were built to survive. And that's exactly what started happening. Farm economies were fragile through the 1910s and into the 1920s, and when agricultural prices dropped, rural banks failed in clusters, not in isolation. The guarantee funds that were meant to cover an occasional failure got hit with failure after failure after failure and simply ran out of money to pay anyone. One by one, these state experiments collapsed under their own weight. By the time the Great Depression arrived, most of them were already gone, or gutted, or meaningless in practice. So the states had tried, and the states had failed, which left one uncomfortable question hanging over the whole country. If a state-level fund couldn't survive a regional downturn, who exactly was capable of guaranteeing deposits through something as big as a nationwide collapse? Here's something that tends to get left out of the popular story of the 1920s. It's remembered as a decade of parties, of stock speculation, of a booming economy roaring toward a wall it wouldn't see coming until 1929. And in the cities, sure, that story's mostly true. But out in rural America, the 20s were already a slow-motion banking disaster. And almost nobody in Washington was paying attention. Farm prices had spiked during the First World War, and small rural banks had grown right alongside them, lending heavily against land and crops that seemed like they'd only ever get more valuable. Then prices came back down after the war, and kept falling for most of the decade. Farmers couldn't repay what they owed. Rural banks, thousands of small, single-branch institutions scattered across the Midwest and the Plains, started failing at a startling rate. Years before the Depression became a household word, well over 1,000 banks a year were already going under in some years of the 20s, quietly, one small town at a time. This is one of the strangest, most undertold parts of the whole story. More small banks failed during the supposedly prosperous 1920s than most people would guess, and it barely registered as a national crisis because it wasn't happening to the big urban banks that made front-page headlines. It was happening quietly, community by community, to the kind of small institutions most of the country never even heard of. A bank in one Kansas farm town this year, a bank in some corner of Iowa, or the Dakotas the next, never enough at once, in any single place, to make the nightly news outside its own county. If you'd told someone living in New York or Chicago in, say, 1926, that thousands of American banks had already failed that decade, they'd have been genuinely surprised. It wasn't happening to them. That's precisely why nobody with real political power felt any urgency to fix it. That mattered enormously for what came next. It meant the American banking system walked into the 1930s already weakened, already brittle, propped up on a decade of unaddressed rural failures nobody in power had bothered to fix. There was no political appetite to protect depositors because depositors weren't the ones with power in Washington. Bankers were, and plenty of bankers actively opposed federal deposit insurance, worried it would reward reckless competitors at the expense of careful ones. Then October 1929 happened, and the quiet rural collapse that had been running in the background for most of a decade suddenly had a lot of company. Between 1930 and 1933, more than 9,000 banks failed in the United States. Sit with that for a second. It's easy to read past a big number like that without actually processing what it means. 9,000 separate institutions, 9,000 vaults that turned out to be empty, or nearly empty, the moment people came asking. 9,000 communities where somebody's savings, a farmer's, a shopkeeper's, a widow's, some kid's college fund, simply stopped existing overnight, with no warning and no way to get it back. Depositors in these failed banks lost more than $1.3 billion combined. In today's money, something like $27 billion. Almost 20% of every single dollar on deposit in these institutions. Just gone. No single failure captures what this actually felt like better than what happened in New York City in December 1930. The Bank of United States was, despite its grand name, an entirely private commercial bank. No government connection whatsoever, though plenty of its customers assumed otherwise. It had been founded back in 1913 by a Russian immigrant, and by the late 1920s, it had grown into the fourth largest bank in New York, with roughly 440,000 depositors and over $200 million on deposit. Most of those depositors weren't wealthy. More than three-quarters of them had less than $400 in their account. This was a bank built by and for New York's immigrant working class, people who couldn't easily get served anywhere else in the city. On a cold morning that December, a small Bronx shopkeeper walked into his local branch wanting to sell back some bank stock, the way the bank had promised he could. The manager refused. Furious, the shopkeeper walked out and started telling anyone who'd listen that the Bank of United States was going under. That rumor alone was enough. Within hours, a crowd numbering into the tens of thousands had gathered outside branches across the Bronx, Brooklyn, and Harlem. Police had to be brought in just to manage the lines. One man reportedly stood in line for 2 hours to withdraw a balance of $2, not because he needed the money urgently, but because the fear itself had become impossible to resist. When you see thousands of people running toward an exit, you run too, even if you're not sure what you're running from. Behind the scenes, New York's most powerful bankers, the same circle that had let Knickerbocker fail back in 1907, discussed whether to organize a rescue. They chose not to. Whatever the exact mix of reasons, the outcome was the same. No consortium stepped in, no guarantee fund materialized, and on December 11, 1930, state regulators shut the Bank of United States down. At the time, it was the largest bank failure in American history. For the depositors, the shopkeepers, the tailors, the factory workers who trusted this bank precisely because it had welcomed them when others hadn't. There was no safety net waiting on the other side. Just a locked door, a court-appointed receiver, and years of waiting to find out how many cents on the dollar they'd eventually get back. Stories like that one repeated themselves often enough that they changed how ordinary Americans behaved, on a scale big enough to matter for the entire economy. People who'd never lost a dollar personally still watched it happen to a neighbor, or read about it in the paper, and drew the obvious conclusion. Banks were no longer where you kept money you actually needed. Hundreds of thousands of people started hoarding cash instead, stuffing bills into mattresses, burying coffee cans of coins in the backyard, anywhere that wasn't a bank vault. It sounds almost quaint now, a little bit paranoid. At the time, it was the only strategy that had actually protected anyone. But that instinct made the whole crisis worse, not better. Every dollar pulled out of a bank and buried in a backyard was a dollar the banking system couldn't lend out, couldn't use to keep other businesses running, couldn't use to pay other depositors who came asking. The distrust that felt like the rational, self-protective choice for any one family became multiplied across millions of families, one of the exact forces dragging the entire economy further down. And this wave wasn't confined to small rural banks anymore, the way the 1920s failures had been. Now it was hitting big, established urban institutions too. Banks that looked exactly as solid as that marble-columned building from earlier. If a bank you'd trusted for 20 years could fail, then no bank was safe, which meant the smartest thing to do, the only rational thing to do, was pull your money out the second you smelled trouble. Which, of course, turned every rumor into a self-fulfilling prophecy. The fear of a run caused the run. By the time Franklin Roosevelt was sworn in March of 1933, this wasn't a crisis anymore. It was just the condition the country was living in. And there's a reason it reached the entire country all at once, instead of staying contained the way earlier panics had. In February of 1933, just weeks before Roosevelt's inauguration, Michigan became the flashpoint. Detroit's biggest banking group was quietly insolvent, propped up by loans and by one very famous depositor, Henry Ford, who personally had millions of dollars sitting in those same troubled banks. Federal regulators tried to broker a rescue, but the deal hinged on Ford agreeing to leave his own deposits in place, subordinated behind everyone else's claims, so the banks could stay afloat while a bailout was arranged. Ford refused. He wanted his money treated like anyone else's, and if it wasn't, he threatened to pull all of it out immediately, which would have finished the banks off on the spot. Whatever the businessman was thinking, principle, self-interest, plain stubbornness, take your pick, the negotiation collapsed, and Michigan's governor had no options left. On February 14, 1933, he declared a statewide bank holiday, shutting down every bank in Michigan by order of the state government. It was supposed to buy a few days of breathing room. Instead, it did the opposite of calming anyone down. If Michigan's banks needed to be shut down entirely to survive, depositors in Ohio, Indiana, and Illinois started asking themselves an obvious question. How do we know our banks aren't next? Within days, the fear had jumped state lines, and it kept jumping state by state, all the way to Roosevelt's inauguration 3 weeks later. That's the part that's easy to miss in the shorthand version of this story. The National Bank holiday in March wasn't really the beginning of the crisis. It was the end point of a chain reaction that had already been rolling for weeks, one governor's decision at a time, each one confirming everybody else's worst fear. By the first days of that March, the panic had gotten so bad, it was feeding on itself in a way nobody had seen before. People arriving in Washington for the inauguration found notices waiting in their hotel rooms warning that checks drawn on out-of-town banks wouldn't be honored. The financial system was seizing up in real time, even in the nation's capital, even for the people about to run the country. By Inauguration Day, every single state in the Union had declared some form of bank closure or restriction. Not most states. All of them. Roosevelt's response, just days into his presidency, was drastic. He declared a national bank holiday, closing every bank in the country at once, and pushed emergency legislation through Congress at a speed that's almost hard to believe. The House passed it the same day it was introduced, and the Senate followed a few hours later. Here's the nuance the popular version of this story tends to skip over, though. Closing the banks didn't fix anything. It bought time. No bank could fail today if no bank was even open today, sure. But it didn't solve the actual problem that had caused 9,000 failures in 3 years. When the banks reopened, region by region, over the following days, the same vulnerability was still sitting right there underneath everything. A bank could still fail. Depositors could still lose everything. The bank holiday was a tourniquet, not a cure, which meant the real fight, the one that would actually decide whether this could ever happen again, was just getting started. And it was about to happen somewhere a lot less dramatic than a nationwide bank closure, a congressional committee room. Before Congress could agree on any of this, though, the public first had to actually see what had been happening behind closed doors. And that's largely thanks to one prosecutor from New York who almost didn't get the job. The Senate Banking Committee had been investigating Wall Street's role in the crash since 1932, and for the first year the hearings were, frankly, a dud. Witnesses came in, gave vague answers, and left with their reputations intact. Then, in January of 1933, the committee brought on a new chief counsel, Ferdinand Pecora, a sharp, Sicilian-born former prosecutor who'd spent his career taking down small-time con artists in New York courtrooms. Nobody on Wall Street expected much from him either. Pecora then proceeded to do something almost nobody in that room had seen before. He'd done his homework, subpoenaed records, cross-referenced numbers, read the fine print nobody thought a Senate committee would bother with. When a bank executive gave an answer under oath that didn't quite match reality, Pecora would simply produce the bank's own paperwork and let the contradiction speak for itself. The most damaging moment came when Pecora got the chance to question J.P. Morgan, Jr., son of the very same Morgan who'd let Knickerbocker Trust collapse back in 1907, and by 1933, arguably the most powerful private banker left in the country. Under Pecora's questioning, Morgan admitted, on the record, that he'd paid no federal income tax at all in 1930 and 1931. Pecora also produced evidence that Morgan's firm had quietly handed out preferential stock deals to a long list of prominent politicians and public figures, at prices ordinary investors never got access to. National City Bank's president, Charles Mitchell, faced similarly brutal questioning over practices like handing out interest-free loans to bank insiders while packaging shaky securities to sell to everyday customers. None of this stayed contained to a Senate committee room. Newspapers ran it as front-page news for weeks. Pecora's face ended up on the cover of Time magazine, cigar in hand, and the hearings gave the country a new word for what people were starting to think of these men. Banksters, a deliberate echo of gangster, coined right around the same moment John Dillinger and Al Capone were household names for an entirely different kind of crime. Here's why that matters for the story of deposit insurance specifically. Before Pecora, the idea that ordinary depositors deserved federal protection was, politically, still a hard sell. Bankers had real influence in Washington, and the argument that insurance would reward reckless banks over careful ones still carried weight in policy circles. After Pecora, that political calculation flipped. It became almost impossible for a member of Congress to publicly side with the banking industry's objections, when the industry itself had just been shown, in vivid, sworn front-page detail, exactly how little some of its most trusted names actually deserved that trust. The Pecora Commission's own final report explicitly recommended both separating investment from commercial banking and adopting deposit insurance, recommendations that walked almost directly into the Banking Act that FDR would sign that June. You'd expect the two men whose names ended up on the bill that finally created federal deposit insurance to have agreed on the idea. They didn't. Not even close. Senator Carter Glass of Virginia was, in a lot of ways, the architect of the broader reform effort. He'd helped create the Federal Reserve System back in 1913, and he walked into 1933 deeply skeptical of deposit insurance specifically. His worry, shared by plenty of established bankers, was that guaranteeing deposits would end up rewarding reckless banks and punishing careful ones, that a well-run bank in New York would basically be subsidizing the failures of poorly run banks somewhere else, with no real incentive left for anyone to run their institution responsibly. Representative Henry Steagall of Alabama, chairing the House Banking Committee, saw it completely differently. Steagall represented a rural district that had watched small local banks collapse throughout the 1920s, well before Wall Street ever noticed there was a problem. For his constituents, the argument about rewarding recklessness was abstract. What wasn't abstract was a neighbor losing every dollar they owned because a local bank failed through no fault of their own. Steagall pushed hard for federal deposit insurance, and he got it into the bill, despite Glass's resistance. The result was the Banking Act of 1933, signed into law by President Roosevelt on June 16, 1933. Most people today know it by its more famous nickname, Glass-Steagall. It's usually remembered for separating commercial banking from investment banking, walling off your checking account from Wall Street speculation. But tucked inside that same law was something arguably even more consequential for ordinary Americans. It created the Federal Deposit Insurance Corporation. The FDIC's initial funding came from the U.S. Treasury, which put in $150 million, plus contributions from the 12 Federal Reserve banks, each required to chip in an amount equal to half its surplus. This wasn't charity. It was a structure, a real funded institution, built to do the one thing state guarantee funds never had the resources to do: absorb a nationwide crisis without simply running out of money. Federal deposit insurance officially began on January 1, 1934, covering up to $2,500 per depositor. That limit got raised to $5,000 just a few months later, on July 1st. At launch, it guaranteed $11 billion in deposits across the entire country. And then something happened that honestly deserves to be one of the most famous statistics in American economic history, and mostly isn't. In 1934, the very first full-year deposit insurance existed. Only 9 banks failed in the United States. 9. Compare that to the more than 9,000 that had failed across the previous 3 years. That's not a modest improvement. That's not a policy nudging a number slightly in the right direction. That's an entire category of financial catastrophe, one that had defined American life for 150 years. From Knickerbocker in 1907 to the Bank of the United States in 1930, essentially vanishing within 12 months. Worth being honest about why that happened, though, because the real answer is more interesting than the government made banks safer. Deposit insurance didn't magically turn badly run banks into well-run ones. What it did was remove the reason to panic. If your $500 was guaranteed by the federal government, no matter what happened to the bank holding it, there was no longer any rational reason to sprint to the counter the second you heard a rumor. And since panic was the exact mechanism that turned one bad loan, or one bad rumor about a candy store owner's stock, into a full-blown run, taking away the incentive to panic took away most of what had been destroying banks in the first place. It wasn't a total, permanent fix either. Banks kept failing after 1934, just not through panic anymore. Between 1934 and 1940, the FDIC still shut down an average of around 50 banks a year, usually through the slow, unglamorous business of bad loans and bad management, not through a terrified crowd outside the door. But here's the part that actually mattered. No depositor lost their insured savings in any of those failures. That was the real innovation. Not that banks stopped failing. Banks still fail today. It's that you, the depositor, stopped being the one who paid for it. So what actually changed underneath all of this? It was never really about banks. It was about a much older question every society with money eventually has to answer. When trust in an institution turns out to be misplaced, who absorbs the loss? For 150 years, the American answer had been simple. You do. Whoever happened to have their life savings in the wrong building, on the wrong week, whether that building was a Roman-columned trust company on Wall Street or a small storefront branch in the Bronx. After 1934, that answer changed. The risk got spread out, backed by the federal government, funded collectively by the banking system itself, so that one family's entire savings didn't have to depend entirely on one institution's competence, or luck, or honesty, or who happened to be running it. It's worth sitting with how strange that shift actually was, historically speaking. For a century and a half, the assumption in American life was that risk belonged to whoever was closest to it. If your bank failed, that was your problem, your loss, your bad luck for picking the wrong institution. Deposit insurance rejected that assumption outright. It said, in effect, that an ordinary depositor shouldn't have to be a credit analyst just to keep their paycheck safe. That some risks are better absorbed collectively than left to fall on whoever happens to be standing closest when the doors lock. And this still matters right now, not just as a history lesson. Today, FDIC insurance covers up to $250,000 per depositor, per bank, a number that's been raised again and again since 1934 for exactly the same reason it existed in the first place. The instinct this whole system was built to prevent hasn't actually gone away either. In March of 2023, Silicon Valley Bank collapsed with more than $200 billion in assets, the second biggest bank failure since the FDIC started keeping records back in 1934, and for a few tense days, the same old question came right back. Would depositors, some of them well above the insured limit this time, actually get their money back? Social media did in 2023 what word of mouth did in 1930 outside a Bronx branch, moved a rumor fast enough to turn a solvency problem into a full-blown run within about 48 hours. The mechanism built in 1934 was still the thing standing between a bank run and a bank simply failing quietly in the background, and regulators still had to reach for extraordinary measures to keep the panic from spreading further. Almost a century after Glass-Steagall first argued about whether any of this was even a good idea. The number in your banking app isn't just a number. It's the end product of 9,000 failures. A run on a marble-columned bank that looked untouchable. A crowd of thousands in the Bronx waiting on a rumor. A state experiment that went bankrupt trying to do the right thing. A president who shut down every bank in the country at once. And two men in Congress who disagreed about almost everything. Except that this had to end. If you learned something here, stick around. This channel exists to dig up the everyday systems you've never once had reason to question, and to show you how much history, how many failures, and how many stubborn arguments in committee rooms it actually took to build them.